We will analyze the Indian agrochemical industry, zeroing in on leading manufacturers of technicals and agrochemical intermediates, as well as some of the CDMO players. By analyzing the sector through the lens of individual companies, we aim to understand similar patterns and what sets them apart. This is not a buy or sell recommendation. We may have holdings in some of the companies we will discuss today. The Indian agrochemical industry, especially companies focused on exports, faced several key challenges. These included a decline in exports due to competitive pricing and market saturation from Chinese dumping, widespread inventory destocking, significant inventory write-offs, and increased debt levels driven by aggressive expansion strategies. The Chinese dumping also affected domestic sales. Some of the companies that we would like to cover in this series are Astec Lifesciences, India Pesticides Limited, NSEL, Bharat Rasaya, Sharda Cropchem, Insecticides India, and Punjab Chemicals. We may add companies to this analysis as if we find anything interesting. Today we will focus on Astec Lifesciences. A quick look at Astec's quarterly profit and loss will give you an idea of what's happening in the industry. It has been posting continuous losses for the past 10 quarters. If you look at the operating margins, it can be seen to be declining continuously from March 2022. Back in 2022, the company was the favorite among analysts and investors. There are a lot of interesting analysis of the company. You can also see that effect if you look at the share prices as well. The reason is clearly visible if you look at the improving annual margins. The margins improved from 13% in 2016 to 23% in 2022. The profits before tax can also be seen increasing significantly from 8 crores in 2016 to 121 crores in 2022 before nosediving. Now, if you look at the balance sheet, the company was continuously expanding its capacities, which can be seen from its increase in fixed assets. It has increased from 115 crores in 2018 to 499 crores in 2025. You can see that capacity increase continued even from when profits started to drop in 2023. So, if the company is incurring losses and you are expanding capacities, what will happen? The long-term borrowings increased from nil in 2022 to 280 in 2025. This has translated to higher interest costs as well. The company in the fourth quarter con call mentioned that they have no more capex plan for Astex until they have more visibility in the business. As mentioned earlier, Astec Lifesciences is a Godrej agrovet subsidiary with 64% stake. In January 2025, Godrej family and Associated Trust made an open offer to acquire Astec shares at a price of 1069 rupees per share. They were able to acquire 4.13% of the share from shareholders. Recently, the company launched a rights issue to raise 249 crores. The entitlement ratio is 1 right for every 7 fully paid equity share. The most interesting part about the rights issue is the issue price of 890. In fact, at the time of initial announcement, the market price was lower than the issue price. This shows to a certain extent the confidence of the promoters in the company. The company has two major portfolios. The first one is the enterprise portfolio and the second one is the CDMO portfolio. The company's enterprise portfolio consists of triazole fungicides like tebuconazole, propiconazole, hexoconazole and difenoconazole. The company is a leader in India and global in triazole fungicides. The company faced significant challenges with subdued demand in the global agrochemical industry, particularly in this segment. The company doesn't speak a lot about its customers. However, some of the major players in this segment are BASF, Bayer, and Syngenta. Triazole fungicides are often called the backbone of fungicide programs because of their versatility, reliability, and broad spectral effectiveness in managing plant diseases across a wide range of crops. They are often used in mixture with other fungicide classes to manage fungicide resistance. Propiconazole, once a flagship triazole in many products, has been phased out in the European Union due to regulatory concerns and has been banned for agricultural use in European Union. You can see this effect very clearly in Astec's results as well. The sales has been muted and the company had to write off inventory worth 20 crores in financial year 2025. Propiconazole was also mentioned as a significant product in Q1 2025 when they had to write off inventory worth rupees 18 crores. The company had a lot of high price inventory, which is the reason for the negative margin for the last many quarters. And even from this quarter results, it is evident that the issue is far from over for the enterprise segment. The CDMO segment was also beaten down due to high channel inventory with their customers, leading to reduced offtake from Astec. Now let's review the latest quarter results. Revenue in enterprise and CDMO business increased year on year by 68% and 85% respectively. This also resulted in reduction of EBITDA losses as compared to first quarter of FY25, which also had an impact of write down of inventories of around 18.5 crores. In agrochemical companies, there is a lot of seasonality involved, especially with the timing of application of a particular pesticides, the crop season, and this may vary from company to company based on the class of product they manufacture and the crops they cater to. So, an year on year comparison may be more apt. But just for understanding the margin scenario, we are just doing a quarter on quarter analysis. From this, one can clearly understand two things. The operating margins has gone down to minus 12% after becoming positive in the fourth quarter last year. It is clearly impacted by the material cost, which has increased to 70% from 62% in the last quarter. If you look at the segmental revenue, both the sales from CDMO and enterprises segment has come down, but it is almost in the same ratio. So that couldn't be the reason for the increased raw material costs. So the one major change has been contribution from exports. The exports have come down from 80% to 50%, bringing down the gross margins. So for the company to turn around, the exports and sales from CDMO has to increase. Now coming to the end users, both Syngenta and Adama have signaled reducing channel inventory. BASF has also forecasted better cash flow this year from agricultural solutions. A key risk faced by the whole agrochemical industry is the tariff uncertainty. We don't know what kind of tariffs will be imposed by US on India. It's not just tariffs on India that would be an issue. The tariff of European Union and Japan may impact those players as well. Also, how would Chinese dumping manifest if they are to lose US markets is also something to be seen. Chinese domestic demand may not be seeing a revival soon. Secondly, regulatory issues with any of its major enterprise products could be another negative. To conclude, we are seeing some improvement in the industry with reducing inventory in the channel and the high cost inventory being out of the system. We may start seeing some improvement in the margins this year. The whole industry was in a euphoria post-COVID and everyone piled on huge inventories and did a lot of capex, much more than the industry required. China Plus One was seen as a great opportunity that didn't really materialize. China continued to dump chemicals worldwide and falling prices were so huge that one of the Indian companies mentioned in the con call that their carrying cost of raw materials ended up to be double the price of final product. For Astec, the CDMO business and exports has to pick up for them to improve their sales and margins. The company doesn't disclose the details of CDMO products that they manufacture or the clients they deal with, so there is not much we can analyze there. The company has commissioned a herbicide plant last year to cater to contract manufacturing operations. With the rights issue, the balance sheet strength would significantly improve, and with phasing out of high cost inventory, the company may come back to profitability at operating levels soon.